Thanks for joining us today. This is Sprague's Market Brief Commentary. Taylor Hudson here with Hugh McNaughton. It's been a while, Hugh. I went on vacation. It's nice to be back with you.
It's good to have you back, Taylor. And although I'm envious as heck of you, where was it? Petite, what's it called? Petite?
It doesn't matter. It was warm, sunny, and there was, anyway. All right. Well, before we get going today, we just want to bring everybody up to date on where the market is. When we came to you last a couple of weeks ago, heating oil was trading in the 326 range, and since that time, we've actually come down through the 40-day moving average. Monday, we had a little bit of a shocker, the 8-cent up day. And Hugh, you said that day really wasn't too much fundamental new news out on Monday.
No, there wasn't, Taylor. It was, in fact, in the beginning, a lot of questions as to why it was occurring at all. And the bottom line is, by the end of the day, I think we concluded it was really computer-generated buying, stop-loss program.
Gotcha. Well, since that time, yesterday we had a little bit of a down day, tested the moving averages again, and then today a real fallout. When I took this snapshot of the market, we were down 633. That was about 10 minutes ago. We're only 2 cents off the March 29th low at 314.37. If we break that level, then I would suspect that we'll try some more aggressive pricing points lower than that. Let's all hope that that's the case. However, if you're of the mindset that refined products like heating oil and gasoline in New York Harbor are really going to follow what's going on with Brent, Brent as opposed to WTI crude is really stuck in a range right now. Down today almost a couple dollars, but you can see by the chart here that since the beginning of or middle of February, we've been trading in this 121 to 126 Brent range. So let's hope that we can get below 121. It might take something from the Iranians, but we'll hope anyway. All right, so what we really want to talk about today was, spring's in the air, and the telephone conversations are changing a little bit here around the office. And we seem to think that we're entering that time of the price protection program. So what we wanted to do was just have sort of a general conversation on a topic that we'll be revisiting for the rest of the spring and the summer all the way into the fall. And what I'd really like to know, Hugh, is from the Sprague perspective, have you all, or have we been, seeing a lot of buying yet for next year?
Well, Taylor, I think you put it very well. What we're experiencing is sort of a tire kicking phase here. We've got people calling in, and a very few contracts being sold. But in response to primarily bid business, municipalities, maybe school districts, that sort of thing. The bottom line, though, is that when they hear the price or they get the pricing information, or maybe they're just inquiring, nothing has been really transpiring.
And just from a historical perspective, me being new here and all, I'm just curious, when do you all typically see some action on these forward buys? When in the past have you all actually seen dealers really start to buy wet barrels for the pre-buys, let's say, for next year?
Well, to some extent, it's a function of markets at the relative market values at the time. And that's sometimes delayed these programs or maybe even advanced them. But I think historically it's fair to say that we're still a good month away from the beginning of the serious initiatives to put these things in place. If I recall correctly, we put out a survey the last year or the year before, which indicated that 30 or 35% of our customers typically, historically, got their programs rolling in May. And the other 60 to 70% came along in June. Of course, there are some that depart from that as well, but that's the kind of historical experience we've had.
Very good. So we're still a little early on the get-go of it right now, historically anyway. Well, I think what we wanted to. I'm sorry.
I was going to say, what I'd be interested to know, though, is you've had some very good, obviously, and do have very good relationships with dealers and customers. What kind of feedback are you getting in terms of the interest in these programs, and especially in terms of downside protection or other influence?
I think generally speaking, there's definitely less price protection being sold in the heating oil retail industry than there was 5 or 6 years ago. Customers and dealers alike have sort of moved away from those types of programs. However, I talked to a dealer yesterday who told me he was pretty confident that he would sell more price protection for this coming season than he did for last year. And the reason was simple. Prices in general through the winter went up, and people on price protection programs felt like they won. So I think you have those folks who are looking at the market having gone up this winter, and probably a little bit of the media hysteria going on with Iran as a reason to think that their customers may be a little more inclined to do something. You mentioned the CAP program, or if somebody were to purchase downside protection on the wet barrel. And I think that's an important point to make, is that I think the interest in a CAP program, generally speaking, has increased over time because it's the one program that dealers can tell their customers, look, you win no matter what happens. The market goes up, you're covered. The market goes down, you get the lower price. Sticking point there is the fee and how to sort of work that into the conversation. But generally speaking, I do think interest in a cap is probably growing.
No question about it, Taylor. And that fee is a very small price to pay relative to having a market, value decline by $1 or $2 on you, and having your customers tell you that they don't want to keep on buying at the prices that you put in place. I have a question for you that might lead on to here. Obviously, the starting position in all of this is, where are we now? What kind of values are we looking at for the coming winter? And I know you've put together some very, if I can tell you, some very good slides on this. So how would you respond to that question?
Well, I think the first thing to do is to know where roughly the heat curve or the forward curve is trading at any given point in time. And that's approximated by us usually with a OCT to April, like you see on this slide, or Novi March heat curve. And this is really just the degree-day weighted average of the NYMEX pricing for those winter months for heating oil, let's say. And you all at Sprague already have put this out. Typically, it comes in an email form through the summer from the contract desk. Usually Dave Doust is putting it out every once in a while, just sort of letting people know where that forward number is. And Hugh, this is a slide that actually you put together and from MarketWatch. So why don't you go through it, and I'll try to run the laser pointer for you.
Okay, that sounds good. This is something we started maybe 6 weeks ago, something along those lines. As of course this consideration became more relevant. What it is just simply that, as you say, degree day weighted curve or representation of this year, or this year's upcoming heating season, and last year at the same time. And it basically takes into consideration just the values on a daily basis that prevailed between this year and last year. To maybe not totally surprising in view of some of the stuff that you and I have done on what transpired in the early part of last year, April, the Libyan civil war and such. We can see here that we've moved very steadily up, but from this time last year to where we are now.
So if I'm reading this chart right, it's telling me that this time last year, if I were interested, let's say, in buying some wet barrels for next winter, the NYMEX price roughly that I'd have paid for that heat curve or strip was around $3.26. And currently, we're right around that level right now for next year.
That's correct, about a penny lower, as a matter of fact.
So that's very interesting, because I think, well, we've been sitting here since the beginning of February, at least, with a huge premium to where we were last year. And it's interesting to note that if you were a buyer, let's say, of wet barrels last April, you probably would be buying in at the same levels today if you decided to put a program together.
Absolutely, a very powerful consideration, especially since most of us have been under the impression, as we have been, that we're running significantly above last year.
That's interesting. So the next question becomes, what if we don't have access to this graph, let's say, at our fingertips? So what we put together were a couple of slides of where to find this proxy for next winter's pricing. And the first place that we wanted to point out was, for those of you who are just adept at finding websites and everything, you can check out cmegroup.com. And if you hover over the link for energy on the top, there's a heating oil choice. And if you just look out at, let's say, February of 2013 and the last print, that'll give you a pretty good approximation of where an OC April strip would be, or a Novi March strip. I always use that as sort of a handy way to get there. Even better way, if folks would open the, I know I personally don't open it every day. I read your comment on the email, but I don't open the PDF necessarily. But for those who receive Market Watch every day, if they open up the PDF that's attached, right here under the NYMEX prior settlement prices, you've provided a very handy place for them to find where that heat curve is currently running.
Yeah, in fact, Taylor, that is the source of the information that goes into the little chart that you pointed out a minute ago.
Thank you. However, those prices, even the chart that I showed at first, is only the NYMEX portion of cost. What it doesn't have in it is the differential if you actually bought a wet barrel. So it's not a full measure of really where your costs would be. So the absolute best place to find a proxy of where you could buy for next winter for these types of programs is actually in our new Sprague real-time system. And if you go under the Forwards tab, on the top, I think most people are used to going to the Prompts tab to see where they could make a buy for today or tomorrow. But if you go under the Forwards tab, there are some choices there. Forward offers, heat curves, and in particular small volume heat curves. And you will get a menu when you go to that tab that in terms of small volume heat curves will show you some potential strips. So OC to April's right here on the top for Newark Sunoco heating oil when I took the screenshot. And if you click on the far right bid/buy button, you wind up here, which is actually the buying page for a small volume heat curve that'll run OC to April. And what's different this year is the fact that we've done what with volume?
Well, Taylor, something unthinkable more than 2 or 3 years ago, when the standard version of this was probably for 210,000 gallons or something along those lines. This is for 1,000 gallons. A purchase of 1,000 gallons spread over 7 months. Is that 8? Yes. 7 months. Less than one homeowner's.
So can I also put in 2,000 or 3,000 gallons if I had, 2 or 3 people who wanted a pre-buy?
Absolutely. You can put in whatever volume you want. You can actually alter the distribution if so inclined, as opposed to the standard degree day. It is really the most user-friendly, even for computer illiterates like myself, system that I could have imagined, anybody could imagine.
The other thing that we want to point out to folks is you don't have to grant buying authority to everyone who can see into your Sprague real-time system. So if you have salespeople or folks who answer the phone and you want them to be quoting people an accurate price, they can actually have access to the screen, and they can simply look at where the weighted average pricing is at the moment and then add a standard margin that you internally in your company have sort of agreed upon, so that your customers are getting a quote that's fairly close to where you could actually hedge it at that given point in time. But this number you see here for this screenshot, this 333.35, is both the NYMEX component of the cost as well as Sprague's differential that they would add. So that truly is the all-in cost for you to hedge some for next winter at that moment, and that'll tick live.
Yeah, your number, your price, your location. There's nothing more you can ask for.
Finally, just wanted to show you, in case you're not inclined to a heat curve or small volumes, we do still also have the traditional 42,000 gallon variety available. It's it's available under the forward offers choice, and you'll come to a screen that looks like this, and it has the forward months on it. It has live current pricing ticking for each month, and you can put in any volume of 42,000 gallons and any combination of months, and the system will actually calculate a weighted average price, and that will tick in real time, and you can submit a market order or in some cases submit a bid. So we hope that this was helpful just to kind of get this topic going. I think Hugh, you and I will be revisiting this every couple of weeks, and listeners can expect to see some updates on where the forward curve is trading relative to where it was last year.
Absolutely, Taylor. It's obviously a very important part of many of our customers' programs, and something that we would really like to emphasize.
All right. Well, with that, we hope everybody has a great afternoon. Thanks very much.